Hello my fellow investors and welcome back to another stock analysis video. And guys, it is that time of the quarter where we are finally going to get started on getting the earnings report for the banks. And if you guys know what happened last quarter, specifically in March with the whole SVB collapse, yeah, this is going to be very interesting because of the fact that, well, Q2 looks at Q1. So all the problems that we just saw with SVB, we're now going to possibly see the same kind of issues, I guess you could say, but with the major banks such as JPMorgan, Citi, Bank of America, etc. So now we actually get to see the real impacts of this thing. We get to find out if it was only centralized to those regional banks, or did it affect the big banks as well, but just to a much lesser degree. And as I said, guys, we're going to be taking a look at JPMorgan, seeing that their earnings is actually coming up on Friday. That is absolutely crazy, by the way. JPMorgan, Citi, Wells Fargo, and PNC, and even BlackRock to some extent, all of these have earnings on Friday. This is a recipe for disaster. And also remember that the 12th, which I believe it is Wednesday, that's CPI day. So this is going to be absolutely insane volatility week to no end. It might serve as actually a pretty good time to sell some options if I'm not mistaken. So obviously I'm digressing here. But with that said, let's actually get started with this analysis for JPMorgan Chase. So starting off, guys, we got over here their earnings. Now, last earnings, JPMorgan just did amazingly, They announced this on the 13th of January. EPS normalized actual came in at $3.57, which is beat by 47 cents. The same thing with the EPS gap actual. They announced the same as the EPS normalized actual and the same beat as well. Revenue actual, $34.55 billion. This was a beat by almost $321 million. And you guys can see right here, well, the announcement date for this is going to be the 14th, as I just showed everybody. However, take a look at this. Well, the EPS normalized actual estimate came in a lot lower, right? 357 to now 335. The EPS gap actual, 340, so that's even lower too, as opposed to before, which was 357. And even on top of that, guys, revenue is estimated to just be slightly above what it was last time. And what's even worse, guys, is take a look at this. EPS revisions. EPS revisions measures the company's EPS revisions relative to other stocks in its sector over the last 90 days. Meaning this is how many analysts have been changing up their estimates as to what they think earnings is going to be. You can see that 5 analysts are saying that this thing's going to come in lower, and 6 analysts are saying that this is going to beat expectations. This is 50-50. That's absolutely insane. So very interesting to see this whole entire just thing, because again, these earnings is going to tell us a lot about the banks in general, how they did, especially with the whole SVB collapse. But with that said, let's jump into now the book value calculator. As you all know, when it comes to banks and utilities and anything that doesn't have capital expenditures, we have to use book value per share. So fortunately, there is no assumptions when it comes to this, but we can still figure out if this is a good price to buy this company or not. We got the ticker for JPM, a market cap of $375.2 billion and a PE of 10.55 with a current share price of $127.47. Looking now at this graph, guys, we can see that on the 1 year, they're down 3.06%. Year to date, they're probably, I thought that they were going to be up, but man, after that collapse, you guys can see right here as of March 3rd, things have fallen down a pretty decent amount. Yeah, and they're down 5.66% on the year to date as well. But again, prior to that, they were actually up a significant amount to $143.66, as you guys can see right now on your screen. 52-week range is $101.28 to $144.34. We are still near all-time highs, but at this point, I don't even know what in the world's going to happen. Coming now back into the calculator, we can see that they do pay out an annual dividends of $4, which is a yield of 3.14%, a payout ratio of 33.11, a 5-year CAGR, a massive 5-year CAGR of almost 13%, with 8 consecutive years of dividend payment. Ex-dividend date actually passed as of April 5th. Payout date is actually going to be April 30th, so pretty much the same month as the ex-dividend date. I actually kind of like that. and they pay their dividends quarterly. And of course, based off of their current shares outstanding and this $4 in annual dividends per share, they pay out, guys, $11.74 billion in dividends every single year. So let's now come, guys, into the fundamentals, and at the end of this I would like to make like a public service announcement, a PSA to say the least, as well as a call for help, if anything, because, well, you know, there is something here that unfortunately we overlooked until this SVB collapse. So don't want to really overlook it, and unfortunately I don't really have a way to figure this out. So again, after this I'm going to call for the help of every single one of you and everybody that you know to see if you guys can help us with this, because I would really like to be really thorough when it comes to this, and I don't want to miss anything at all. So I will mention that at the end of these fundamentals. So let's start off with the net income. We got 5 years ago of $32.5 billion to today of $37.68 billion, increase of 16.02%. Now take a look at this net income, guys. We can see that from 5 to 4 to 3 years ago, it was increasing, and then 3 years ago, COVID related, perfectly understandable, right? This is perfectly understandable. Collapse, going from 36.43 to 29.13. Okay, COVID related, that's perfectly fine. However, take a look at this 2 years ago, a massive jump from 29.13 to $48.33 billion. That's an insane increase, guys. And it's funny because I've had a couple comments, especially in my CLSK video, the Clean Spark one. A couple people have been saying something along the lines of like, you clearly don't know what it's like to just have, I guess, like a jump in revenue or something like that, or to be like innovative and get like a massive jump in revenue. Yeah, that's what we call outliers, and outliers do not signify a trend, right? Just because you have an outlier doesn't mean anything to me. And if this was 2 years ago, if this was still back in 2021, or actually the beginning of 2022, and I saw this right here, I saw this massive jump over here, I would have told you guys, hey, be careful, because this is an outlier. Now, some of you may have agreed with me. However, some of you may have been like, no, this will continue to go up because COVID, it'll never go away and we're going to live like this forever. And what happened the following year? Take a look at this, from 48.33 billion to 37.67 billion. Interesting. It's almost like right here, this trend from 5 to 4 continued 1 year ago. You can see that very well, right? 32.47, 36.4, and then 37.6. It continued the trend, excluding these 2 years. This is what I'm talking about, guys. Whenever you see any kind of just massive drop or massive spike, you need to figure out why it occurred. Because at the end of the day, these kinds of spikes, they are not a trend. They could be a trend, don't get me wrong, they could be a trend, but more often than not, they're not. And if you fall for them, well, you're going to get a drop like this, and then you're going to be holding the bag if this drop continues. I'm not saying that will continue with JPMorgan, but I'm just saying in general, spikes do not signify trends. So for this net income just coming down and falling back into trend after 2 years of nonsense, I'm going to give this, guys, a 70%. Looking now at the total revenue, very similar to that of the net income, guys. In fact, it's nearly identical. Look at this, five years ago of $103.7 billion to today of $122.31 billion, increase of 18%. Now we can see a nice steady increase from 5 to 4. Then the nonsense happened 3 and 2 years ago, as I just explained, and then they came back down to normal 1 year ago. You can see 103, 110. I mean, 102 still fairly high, right? I mean, I would have preferred like 115, maybe like 117, but it's not almost $131 billion, which is what they did in revenue 2 years ago. Again, falling back in line with the trend. In fact, if you even take a look at this trend line, this 1 year ago value is touching the trend line as well as the 4 year ago value. So again, it really does matter. You can't take a look at outliers, either up or down. So there you go. Now for this reason, seeing that this did fall from 131 billion to 122.31 billion, it's not that big of a drop as opposed to that of the net income, so I'm going to give this a little bit higher of a grade at 75%. Looking now at the shares outstanding, JPMorgan, major bank, they have been buying back shares nonstop, even during COVID. Take a look at this, 3.27 billion shares outstanding 5 years ago. 3 years ago when COVID hit, it was 3.05 billion shares, and then as of today, it is 2.9 billion shares. Massive share buyback, as you guys can clearly see, at 10.41%, so almost 10.5% in the past 5 years. And even from the previous to the current year, it is a little bit more than 1/3 of a percent. Really, really solid, guys. Not a single year did they increase it at all, so I'm going to give this a 100%. Looking now at the total assets minus total liabilities. This one's major because banks, well, I mean, one of the reasons why SVB went down, it was because of the fact that they just had a lot more treasury bonds that were really out of date maturity, and they didn't have any liquidity, and they couldn't sell those bonds because interest rates went up, the bond prices went down, so their bonds that they had were in the negatives, right? So they would have sold them at a loss, but they needed liquidity, so they couldn't sell them at a loss. It was literally like being stuck between a rock and a hard place. I don't believe JPMorgan is in that position. However, I'm going to ask for everybody's help after we take a look at this assets minus liabilities. As you guys can see right here, guys, this is looking really good, right? We can even see the drop in the total assets minus total liabilities like we just saw in regards to the net income as well as the revenue. You can see that really nice consistent increase, no massive outliers, but still really nice consistent increase from 5 to 2 years ago, and then a slight drop from $294 billion 2 years ago, again that was 2021, to now $292.3 billion as of 2022. Small drop. I'm not really worried about this. But as you guys can clearly see, I'm not giving this a 90% or higher, and I have my reasons. Average total assets, it is $3.3 trillion. That's a trillion, by the way, because all of these numbers are in millions. So that's a trillion. Average total liabilities, it is $3 trillion, and doing this difference, we get $279 billion. Now, the reason why I'm not giving this guys a 90 or higher is because, well, this is where I kind of need your help in. Unfortunately, when it comes to banks, I did not think about looking into their asset allocation. Pretty much looking at what treasury bonds they hold. I don't even know if you could do this. I did a little bit of digging on the internet. However, what I found, I don't believe is what I am looking for. So if you guys know if there is a way to take a look at a bank's portfolio, like what kind of asset allocations they have in regards to the treasury bonds, that would be great, because we really do need to address this treasury bond yield. As you guys can see, this was the cause for SVB going under, and right now the yields are very, very high. In fact, the 6 months is almost 5%, 4.81. In fact, this one did reach 5% a while ago. So this is something that we desperately need to know to figure out what percent of these treasury bonds are in the later maturity, at least for a year. Actually, I wouldn't even say a year. I would say like the 5 to 30 year bond. Because if the majority of them are in this kind of category over here, the 5, 10, and 30, that means that they're probably going to be in the same situation as SVB. Now, JPMorgan, I don't believe that this is the case. I would like to think that they're smarter than that, but I don't trust them because I haven't seen it, right? So again, I would really love to see if you guys know where in the world to find these asset allocations in regards to their treasury bonds, because this is now apparently a thing that we have to look up for, because that was the reason as to why SVB went under in the first place. So I'm going to give this an 85% for now. I think it's not too bad. I don't think they have this problem, but it's still something that us as a financial community, not just me, by the way, every other channel that does finances, we need to figure out a way. I don't even know if there is a way, then okay, I'm wrong. I would be really happy if you guys would tell me, so that way I could bring that information to you guys as well. But I really would like to know of a way to figure out each bank's asset allocation in regards to how many treasuries they have, as well as the maturity, like the average maturity. Again, I believe I found the website, but at the same time, I don't know if what I found was JPMorgan's asset allocation portfolio or something else. So if you guys can help me with that, that would be awesome. So with all of that said, guys, here are the overall grades. We gave the net income a 70%, revenue 75%, shares outstanding 100%, assets minus liabilities 85%, overall grade of 81. Even still, with this whole SVB collapse, guys, I don't believe that JPMorgan has the same problems as, SVB, right? JPMorgan, I mean, they've had a bunch of new people come in because of the SVB debacle and the whole regional banks debacle. In fact, I believe Treasury Secretary Yellen, she was just like, no, we encourage people to take their money out of the regional banks, the small banks, because FDIC cannot 100% secure the small banks, because unless they do ample amount of damage to the economy, we are not going to care about them. So we're only going to care about the big banks. So pretty much telling everybody, hey, take your money out of the little banks, put them into the big banks, because, well, that's where your money is going to be safe, not in the small banks. So at the same time, it's like, I have no idea what's going to happen with this. They seem pretty okay. They seem to be favorable by the government. I don't necessarily like saying that, because it kind of means that if they do go under, there'll be a bailout, and I hate bailouts. But at the same time, I'm kind of looking at the situation that we currently have, and you got to analyze it to the best of your ability, and I believe that this is what's currently happening. So 81%, even with these situations, I still think that JPMorgan is by far the best one that's situated for any kind of problems that may show up in the near future. So with that said, now let's actually jump into the valuations, taking a look at the book value per share. And as of today, guys, the book value per share, it is $90.29. This is up 28% from the past 5 years. So based on the book value, this means that JPMorgan should be worth $90.29. Now looking at the tangible book value, this is removing anything that is non-tangible, we get $72.27, increase of 30% in the past 5 years. And of course, if we take a look at the price divided by the current book value, we can see that it's expensive. It really is expensive. Again, it should be worth $90. Now, I believe the $90 price we saw was back in, COVID? I believe that was when the last time we saw that. In fact, let's actually bring this back up. Let's go on to the 5-year. And if we come over here to COVID, yeah, we can see that it was around like $79. That's absolutely crazy. But yeah, like the average price at around like the COVID era, I'm gonna call that the COVID era, was it around like the $90, $100 mark. And again, we did see again another big drop as of October 10th, 2022, where it reached a low of $101.96. That may have been a better price to buy it at rather than today at the price of, as we saw, at around $127. So yeah, right now it's expensive, and if we take a look at this in regards to the tangible book value, it's even more expensive. It's almost double. So yeah, it's it needs to drop, right? Based on the book value and tangible book value perspective, it does need to drop a significant amount. So it is what it is. This takes into account no assumptions. Still though, I highly suggest everybody gets these calculators. They're available for free, as well as when the earnings come out, guys, I will cover the earnings as well, and then we'll take a look at this and see if maybe the price changed during the day when the earnings came out or something like that, to see if maybe we would like to pay the premium, or if maybe we would like to wait, whatever it may be, right? So I'm gonna also cover the earnings report. Don't worry about that. I will cover the earnings report for all the banks, even though I will cover all of them this week. We are going to cover the earnings report that weekend as well. So yeah, just be on the lookout for that. But again, please have all these calculators. They're available for free. All we're asking for in return, guys, is just like, subscribe, comment. It really does help out with the algorithm on YouTube. So thank you so much for everybody who have subscribed. We really do appreciate it overall. And it's just been absolutely crazy. Hopefully everybody liked that hour-long video of the deep dive of 3M. If you guys haven't checked it out, make sure you check it out. Yeah. It's interesting to say the least. Give me your opinion about that if you guys have one. But with that said, now let's jump into how much in dividends you would get for this company if you put in $5,725. Well, at the current share price, guys, again, this is expensive, you would get $179.66. Now, I am actually very, very curious when it comes to this. Changing the price to $100, doing this, guys, we can see that now the annual dividends for the same amount of price, it is $229. So again, it really does show how much price actually matters. And by the way, at $100, it's technically still overpriced. If we were to put that at 90, it would be a lot more. But let's just say that it doesn't fall back down to 90, that it stays at above like the $100 mark or so. $229 is still really solid when it comes to a company of this caliber. And if it does fall down to around like $100 again, I will probably be buying around a few, maybe 10, 20, or even 30 shares if I am able to. And lastly, taking a look at the options chains. Obviously, when it comes to liquidity, they have weekly expiration, so that's perfectly fine. For April 14th expiration, guys, we can see that they have a lot of good premiums over here. I mean, guys, it's going to be a ton of volatility this week, so maybe a good time to capitalize on all of this. In fact, look at this. Going all the way down to a strike of $120 for April 14th. It is $52 in premium for the put side, and for the call side, if you do have 100 shares and you want to sell a covered call, this is massive, guys. This is absolutely massive. Imagine you bought this thing at the low of like around like $101 or so back in October. You have 100 shares and you would like to sell this thing at like what, 134. You would get a premium of $50, and on top of that, the capital gains of the difference between 134 and 101. So times 100, of course. So that's absolutely insane. If you guys would like to do that, you know, do that. But then again, remember, if it does get exercised, you will lose your shares. So just keep that in mind. Overall, though, options chains, it's what you would expect from a major company like JPMorgan. All in all, guys, thank you so much for watching. Again, I really would like everybody's help to figure out how to find out where we could get the asset allocation for the treasury bonds for banks. I really would like to know, because I would like to read that article. Maybe it's in their annual report, maybe it's in their earnings report. Regardless, though, if you guys know of a way to do it, please leave it down in the comment section below. Anyways, guys, that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link is in the description below. So with that said, peace out, and we'll see you all in the next stock analysis video.